Hello everyone. Today I'm presenting our study titled The Impact of Exchange Rate Volatility on Malaysian Exports based on the COVID-19 pandemic. There are totally 6 parts: introduction, literature review, data source and the preliminary tests, static panel model, dynamic panel model, and the conclusion. For the introduction, the background. The COVID-19 pandemic, which began in early 2020, led to a significant global economic slowdown. International trade value dropped sharply due to widespread lockdowns and disrupted supply chain. As a highly open economy, Malaysia depends heavily on exports, which account for a large share of its GDP. At the same time, financial markets experienced heightened uncertainty, causing greater fluctuation in exchange rates. For the research question, our study aims to answer two main questions. How does exchange rate volatility affect Malaysia's exports? Did the relationship between exchange rates and exports change during the COVID-19 pandemic? To explore these questions, we use annual data from 2000 to 2023. The dependent variable is Malaysia's total export index. The key independent variable is exchange rate volatility, and we include control variables such as inflation and the GDP. We also introduce a dummy variable to represent the COVID-19 period from 2020 to 2021. For analysis, we apply both static and dynamic panel models to ensure robustness and account for time effects. For the literature review, theoretically, exchange rate volatility discourages exports by ending costs and the risk from firms, though risk-tolerant firms may expand trade. Empirically, studies show mixed results. Volatility generally reduces trade, but the impact varies by industry, partner, and financial market development, with stronger negative effects where our hedging tools are limited. The COVID-19 pandemic amplified this dynamic, causing sharp trade drops followed by uneven rebounds. Lockdowns and supply chain disruptions significantly reduces global trade interconnectedness. However, research gaps remain regarding Malaysia's recent export performance, especially during the pandemic. Our study addresses this by analyzing Malaysia's exports up to 2023, specifically examining how exchange rate volatility interacted with pandemic shocks to inform future trade resilience policies. Well, let my partner continue the next part.
Now let's move on to part 3, data source and preliminary tests. For the data, we collected annual observations from 2000 to 2023. The sample includes Malaysia and its 8 major trading partners: China, India, Brazil, South Korea, Mexico, Indonesia, Australia, and Japan. Our key variables are export, which is a dependent variable, measuring Malaysia's annual export value to these partners. Exchange rate volatility, calculated as the annual standard deviation of monthly exchange rates against the US dollar. GDP, representing the economic size of each partner country. Inflation rate based on annual CPI growth. And finally, the COVID-19 dummy variable, which equals 1 for years 2020 and after, and 0 for before 2020. Here are the descriptive statistics for our variables. For exports, China has the highest average export volume, followed by Japan and Australia. Brazil and Mexico show the lowest export volumes. In terms of GDP, China also ranks first but with higher volatility, while Japan is the most stable. Indonesia has the lowest GDP among these countries. Looking at inflation, Brazil has the highest inflation rate, followed by Indonesia, which also shows the largest fluctuations in inflation. Japan has the lowest inflation rate. Finally, for exchange rate volatility, Indonesia has the highest volatility, while Australia shows the most stable exchange rate. We first tested the stationary of all variables using the IPS and feature additive tests. The results show that LN export and LN GDP are non-stationary at the level, but become stationary after first differencing. In contrast, inflation rate and exchange rate volatility are stationary at the level, which means they are I0. Because we have a mix of I1 and I0 variables, panel cointegration methods are suitable for further analysis. Now that we have completed the preliminary tests, we move on to part 4, static panel model. In the static panel model, our dependent variable is the log of Malaysia's export to its partner countries. The independent variables include exchange rate volatility, log of GDP of partner countries, inflation rate, and the COVID-19 dummy variable. In the static panel estimation, we tested 3 models: pooled OLS, fixed effects, and random effects. We used several selection tests, the F-test and the Birch-Pagan test. Both rejected the pooled OLS model. The Hodgman test indicated no significant difference between fixed and random effects. Based on these results, we selected the random effects model for our analysis. Looking at the key variables, GDP is positive and significant in all models, meaning larger partner economics boost Malaysia's exports. Inflation is negative in OLS but turns positive and significant in FE and RE, showing that heterogeneity matters. Exchange rate volatility is only significant in OLS but not in FE and RE. The COVID-19 dummy is nearly significant at 10% in FE and RE, showing some pandemic adjustment effect. In summary, GDP has a strong and consistent positive effect. Larger economics import more from Malaysia. Inflation shows a positive and significant impact of controlling heterogeneity, possibly due to increased consumption or investment doing moderate inflation. Exchange rate volatility is positive but not significant, meaning its effect remains unclear and may be influenced by other macroeconomic factors. COVID-19 dummy is marginally significant, suggesting that the pandemic brought some structural changes in Malaysia's export patterns. After completing the static panel analysis, we now proceeded to part 5, dynamic panel model. Static models like pooled OLS, fixed effects, and random effects can capture relationships, but they ignore time dynamics. However, export performance may show lagged effects, also called export inertia and long-run adjustment. Static models cannot separate long-run and short-run effects. To handle this, we adopt a dynamic panel model using ARDL PMG, which allows for better analysis of both short-run and long-run impacts. But before applying it, we need to confirm that co-integration relationship exists. We first tested whether a long-run equilibrium relationships exist among the variables. We use both Padrani and co-integration tests. In the Padrani test, both panel ADF and group ADF statistics are significant at 1% level. The cow test also shows significance with an ADF statistic of -3.423. Overall, this result confirms that co-integration exists between Malaysia's exports, GDP, inflation, and exchange rate volatility. To further verify co-integration, we also applied the Johansen-Fisher test. The test statistic is 107.9, which is strongly significant, rejecting the null hypothesis of no co-integration. Individual country tests also support the presence of multiple co-integrating vectors. In summary, Padrani, Cow, and Johansen-Fisher tests all confirm that a stable long-run equilibrium relationship exists. This allows us to proceed with the PMG dynamic panel estimation. In the dynamic panel model, we use the PMG ARDL approach to estimate both long and short-run effects on Malaysia's exports. The model includes locked exports to capture export persistence effects, long-run explanatory variables or GDP, exchange rate volatility, inflation, and the COVID-19 dummy, and short-run locked differences to account for short-term adjustments. we estimate two model specifications, one without the COVID variable and one with it. Model evaluation focuses on the error correction term significance and sign, as well as standard criteria like AIC, SC, lot likelihood, and RMSE. Here are the PMG results without the COVID dummy variable. In the long run, GDP is positive and highly significant, showing larger economic boost Malaysia's exports. Exchange rate volatility is positive and significant, suggesting it may help exports. Inflation is negative and significant, meaning it suppresses exports long-term. In the short run, GDP change has a significant positive effect. Inflation change shows a short-run positive effect. Exchange rate volatility is not significant. The error correction term is negative and significant 562, showing stable adjustment to long-run equilibrium. Overall, model fit is good. Next are the PMG results after including the COVID dummy variable in the long run. GDP remains positive and highly significant. Exchange rate volatility becomes insignificant, suggesting that the pandemic may have weakened its influence. Inflation remains negatively significant, showing inflation suppresses exports in the long term. COVID-19 dummy is positive and significant, suggesting that the pandemic may have boosted exports. In the short run, GDP change remains positive and highly significant. Inflation change is still positive and significant. COVID-19 dummy change shows a negative short-run effect. Model fit remains acceptable with AIF of minus 1.005 and RMSE of 0.115. Let me summarize the key findings. Exchange rate volatility was significant without the COVID arrival, but it became insignificant after controlling for COVID. This suggests that the pandemic may have disrupted the unusual exchange rate. COVID dummy is significant in both the long run and the short run, confirming that the pandemic had a structural impact on exports. Inflation remains significant in both models, consistently influencing export performance. The error correction term is always negative and significant, indicating stable long-run adjustment mechanisms. In conclusion, including the pandemic variable improves the robustness of the model. The PMG model successfully captures both the structural shifts caused by the pandemic and the dynamic adjustments in Malaysia's export trade. Finally, we performed several post-estimation tests to check the reliability of the model. First, the error correction term remains negative and significant at the 1% level, confirming the long-run adjustment mechanisms. Second, the model fit is supported by AIC, SC, and HQ information criteria, as shown in Figure 1, indicating that the selected lag structure is appropriate. Third, for residual diagnostic, we observe slight skewness in residual and the Sharp-Berry test suggests normality. However, this does not affect the consistency or efficiency of the coefficient estimates. When comparing the static and dynamic models, some clear differences appear. First, LNGDP is positive and significant in both models, confirming its role as a key export driver. For inflation, the static model shows a positive effect. In contrast, the dynamic model shows a negative long-run effect, while the short run remains positive, indicating a time-dependent impact. Regarding exchange rate volatility, it is insignificant in both models, suggesting a limited or unstable influence on exports. Lastly, deCOVID is insignificant in the static model but becomes positive and significant in the dynamic model, showing that pandemic policy supported export adjustments. Now we move on to the final part, conclusion. Main findings. The economic size of partner countries is the key driver of Malaysia's export. Inflation has dual effect. In the short run, it stimulates demand. In the long run, it may hurt competitiveness. Exchange rate volatility plays a limited and unstable role, especially after accounting for macro shocks. The COVID-19 pandemic had a structural positive impact through diversification, market expansion, and digital trade. Policy implications focus on strengthening long-term economic fundamentals, build stronger resilience against external shocks like future pandemics, rely less on short-term exchange rate adjustments, expand export diversification, and develop digital trade. By combining static and dynamic models, this study captures both short-run fluctuations and long-run structural factors in Malaysia's export performance.